In this segment, I want to talk about 1031 exchanges. Now folks, 1031, all that's referring to is the IRS tax code number that talks about these. Now, in a 1031 exchange, what you're trying to do is defer the gain on the sale of, let's say, property. Okay, so let's say you bought this property for $100,000 originally. Now you want to sell it for $200,000. Okay, so you have $100,000 that you want to defer. In a like kind exchange, you have to buy, for it to be effective, you have to buy of equal or greater value. So for me to defer that $100,000 gain, what I want to do is buy another property for at least $200,000 or more. Now by doing so, that $100,000 deferred gain gets transferred over to the new property. So let's just say, for all practical purposes, I exchange it for some property worth $220,000. Now my basis in that new property is $120,000 with a $100,000 gain starting with day one that'll have to be paid down the road when I sell that property. Now, I have to be careful because I can't incur any new debt when I do one of these kind of exchanges. That'll create what's called boot and then can make some of it taxable, so you got to be careful of that. I have to use what's called a qualified intermediary. What the qualified intermediary is going to do is going to hold the proceeds from the first sale, and then they're going to hold them towards the purchase of the next sale, where you can't receive any of the proceeds. Okay, it's going to be very important. And there's actually what they call a qualified intermediary agreement that has to be part of this arrangement as well. So they effectively they hold the proceeds, and then they try to make the sale happen properly according to the rules. Now, the property must be like kind. You know, it has to be, if you're doing real estate, it's going to be real estate you're going for. You have to be able to identify that property that you want to exchange for. You have to identify it within 45 days of the close of the property you just sold. So you sell the property for $200,000. Now you've got 45 days to get out there and try to find what property that you're going to purchase. Now there's different ways you can identify these properties. You can identify 3 and then maybe just close on the 1. There's some other ways you can identify a number more properties, but you have to meet certain rules. Now, all that being said, you identify the property within the 45 days. Now you got to close on that property within 180 days. So folks, as this is something that you'd like to maybe look at or do, it can be very valuable, but it comes with some very tight restrictions or rules associated with it that you're going to want to know about. If there's anything like that we can help you with, then give us a call.